Hey everybody, it is good to be here today. My name is Brent Moores, and it's time for investing in dividend stocks. Today I want to talk about finding potential trade candidates, investing candidates for dividend stocks, focusing on a particular type of dividend stock that we've talked about in the past. I want to give you some more detail on that and maybe a slightly different approach than what we've done, and kind of a clearly delineated step process, four-step process. And to do so, I'm joined by Ben Watson in the chat. You know, I've been working with Ben for over 2 decades now, and I appreciate him. And if we ever workshop in your area, Ben is probably the guy there for you. So go out and meet Ben there at the workshop. He also teaches some webcasts throughout the week, and follow him on X at Ben Watson CS. At Brent Moore CS is my X handle. I post content throughout the week on there to hopefully help you out. Now, before we do this, let me just mention a few important things. One of those is that the material today is intended for general informational and educational purposes only. What that means is this isn't an individual recommendation or personalized investment advice. And Schwab does not recommend the use of technical analysis as a sole means of investment research. And we're talking about dividend-paying stocks today. There are risks associated with paying in dividend-paying stocks, included but not limited to the risk that stocks may reduce or stop paying dividends. There's also the risk that the stock just goes down in price enough that the dividend may not even be the biggest factor there. It's just the stock price. But just realize there's risks there. The paper money software application, which we will be using today, is provided for educational purposes only. All investing involves risks, including loss of principal, and past performance is no guarantee of future results. I'm not planning on dealing with REITs today. We've done that in the past in this webcast. If you'd like, you can look at the playlist for this webcast. I know Cam did one on REITs not that long ago. So I'm going to skip that, but just realize I may mention diversification, but diversification does not ensure a profit. It does not protect against losses in declining markets. Okay, let's do this. Now, let me pull this up, and here's what I want to talk about today. I want to talk about maybe like a four-step process here for finding and evaluating dividend stocks. And the first step is to build your watch list. So what I'm going to do is today, I'm going to go ahead and I'm just going to kind of outline it to try and make it nice and easy for you. Build your watch list. And for our purposes today, I'm going to use the Dividend Aristocrats watch list. That's for us specifically today, but you can do different watch lists on there. I think it was Ben Watson, in fact, who substituted in this webcast, I don't know, a week or two ago, maybe a couple weeks ago, that talked about dividend kings. We're talking about dividend aristocrats today. Let's talk about what those are and how to talk about how to get those. Okay. When a stock pays a dividend each year, that they may continue that dividend. It may be cut. It may be increased. It may be discontinued. The Dividend Aristocrats list is a list of S&P 500 stocks that have increased their dividends for 25 years in a row. Okay? Doesn't mean the dividend's huge. Okay? You can do small increases each year. But the fact that they've increased it 25 years in a row shows, one, they have a history of being able to pay a dividend. That's a good thing for most investors. Because, hey, let's be honest, most companies are going to hit some hurdles over 25 years. There's going to be some challenges. There's going to be things like COVID that comes out, or tariffs that come out, or recessions that come out, or the financial crises that come out, such as the 2007-2008 financial crisis. And if a company is able to continue to increase their dividend through those, That's saying something about the company. It's not saying everything. It doesn't mean the company is guaranteed to go up, but for a lot of investors, that's a start. And so if we can use that watch list of S&P 500 stocks that have increased their dividend for 25 years in a row, that's a good thing. Okay, so we're going to start with this watch list here. Now, let's do this. Let's going to go to the second step, and we're going to talk about evaluating those stocks in that watch list. Now, how do you get the watch list? You can Google it if you want. Easy enough. You can Google it, and I'm not going to go there. You guys can do that on your own. Go to Google, type in Dividend Aristocrats, and do that. Okay. Another way that makes it easy is you just go to watch list, and it has 25 plus year dividends. Go to public watch lists, and under public watch lists, they have 25-year plus dividends. Click on that, and that's essentially your Dividend Aristocrat watch list. Easy peasy. All right. Now, if you do go on the internet and you decide you want to do this watch list or a different watch list, maybe you do a Dividend Champions watch list. There's one of these other watch lists, some other watch list, and they list out, and you want to add a watch list, you can do that. You can just go down, you can click here, create a watch list, and you can import the watch list, just like that. Okay? Click on import. If you have a list of symbols that are copied to your clipboard, click on paste symbols from clipboard. Fair enough. If you have a file you want to import, like a CSV file, a spreadsheet file, you can do it that way. Click on file and you can import there. I'm not going to do that in this case. In this case, I'm just going to go with the list that we have here. Okay. So that's the first step. Build your watch list. Today, our example watch list is Dividend Aristocrats. Then the second step is going to be, we're going to evaluate the business. Okay. So what are we going to look for in this business here? Well, we're going to make sure that this business has strength to continue to hopefully continue to increase their dividends, and that the company is going to hopefully continue to grow, because not only do we want the dividends, we want the stock price to go up as well. And there's going to be different aspects of finding a strong company. The goal is find a strong company. Okay. Find a strong company. That's the second step. So how are we going to do that? Well, let's start with this. Let's just start with a list of stocks. Now, here's a preset watch list. And if you want to go to a scan, and we're going to start with that, I'm just going to minimize this on the side. If you and I'm going to remove all our filters here. So we're starting from scratch here. Now, let's say you imported the watch list. You could go up here, you can scan in, go to your personal watch list that you imported, and look there. In this case, we have the public watch list we're going to use. Same thing, 25-year plus dividend. That's our Aristocrats. And if I were just to scan that, I'd come up with, hold on, somehow I've intersected with weeklies up there. I don't want that in there. Not sure why that came up. Okay. There we go. We got 65 results, but we're probably going to narrow this down. And this goes back to the diversification aspect of this. So I'm going to narrow this down. Furthermore, as I mentioned, just because the stock's been paying a dividend for a lot of years doesn't mean the dividend is very high. If I go and say, we could put in a yield, for example, I'm going to customize this list, and I'm just going to type in dividend yield, or yield, doesn't matter. Click on OK and pull this up, and I sort this watch list by the yield: 0.28%, 0.7%, and so on. Some of these here are very low yields. And you go, like, how, if they've raised their dividend for 25 years in a row, can we get to the yield be so low? Well, if the company is growing fast in terms of the share price, then the yield may stay low if even though that they've paid out their dividend, especially if they're increasing their dividend at just a minimal amount each year. And some companies will do that. They'll raise their dividend a little bit each year because they want to be known for raising their dividend each year. That attracts investors. That attracts interests. Okay. So so we may want to just kind of narrow it down and say, you know what? Yes, technically they're paying a dividend that's increasing, but I'm not really that interested in those. Okay. So I'm gonna clear out that. And what I'm going to do in this scan is I'm going to just I'm going to add a filter, and I'm going to just add stock filter. And I'm going to say, I just want a minimum yield here. So I'm going to scroll down here. I'm just going to click on yield, and I'm going to say minimum of 2.5%. Okay. So we're going to go 2.5. Let me try that again. 2.5%. And I'm going to scan there, and that narrows it. It cuts the list in half, essentially there. Now, there's something else I want to do. For the sake of our diversification in a portfolio, I don't want all these companies to be in the same sector. And some of these, I'm not sure what the sector is. Maybe I don't know what, McCormick is in, the sector's in. So what I would suggest you do is just add a column. You can customize the column headers. Here I have last, net change, EPS, yield. I can change those, and I can also customize it, and I can add in sector here. Sector. And let me click on OK. And it just got it kind of scrunched down there a little bit, but we're going to pull this up here. And here's our sector. I'm going to sort by sector, and you can see we got a lot of staples here. Well, let's be honest. Staples are kind of known for dividends, and probably a lot of your portfolio, if you're a dividend investor, has staple stocks. So maybe you want to look at other ways, other sectors here to potentially invest in. And we can look at these. Now, there's other columns you can add here. We can add PE ratios, right? We can add earnings per share. For example, I have earnings per share. But for a lot of these factors, such as EPS, that number itself doesn't really tell me that much. Because when we get to evaluating the business, what we want is, we don't just want EPS. We do want earnings, that is true, but we want growing EPS. And this EPS number isn't going to help me with that. So I'm not worried about that right now. I'm just doing an initial scan here on this, and I'm sorting it. And I found all the dividend aristocrats that are paying at least 2.5% in these different sectors. And for our purposes, let's just look at industrials here. Okay, so I'm going to look at industrial stocks, and I'm going to go to these, and I want to just show you how we're going to evaluate these. So let me pull up, we'll start with AOS here. So I'm going to pull up AOS. And a lot of the fundamental helps if I type it in right. A lot of the fundamental information I'm going to look at here is on the Analyze tab, Fundamentals page. Now, some of you may be asking, can we go through a similar process using Schwab.com? And the answer is, yes, you can use Schwab.com. Okay, you can use Schwab.com. The last, I think, 3 times I've taught this webcast, though, I've used Schwab.com. So I'm just going to mix it up a little bit here, and I'm going to use the Thinkorswim platform as well. If you want to look at some of those and you want to see the process, I'm not going to go through the exact same subject today, but evaluating companies using Schwab.com, you can just go to the playlist for this class and see that, okay? And we'll see this. But here I have AOS, okay? A.O. Smith Corp. And the step number 2 that we had was we're going to evaluate that business. And one of the things we're going to do is I want to consider the company on various aspects, including we're going to look at things such as earnings per share, but we're going to look at the growth rates on those. On this page, you can see listed out here, year by year, most recent is on the right, the growth rates. And I'm a little bit more concerned about the last few years than the first couple. And to be honest, we're actually getting far enough out of this, but that COVID is becoming maybe less of an issue. But remember, we had COVID that was really affecting things substantially. So there were some, we don't need perfection is my point. But generally what we like to see are increasing earnings is the first thing I want to look at. And we can look at this and we could say, well, earnings 369, just going back a couple of years, to 363, to 385, so-so is how I'm going to characterize that. Not spectacular growth, maybe a little growth, because if we go back another year, I mean, again, this may have been a post-COVID type situation where it was artificially low, but we've seen some growth on that. But that's the first thing I want to check is that earnings per share growth. Addition to earnings per share growth, what I want to see is sales growth, sales per share growth. And we can do the same thing. And you can see, yeah, kind of, we'll say tepid growth here on this. Is that a fair characterization? It's been going up a little bit, but nothing spectacular on that. Sales per share is the top line. Earnings per share is the bottom line. Ideally, we see growth in both of those, both the top line and the bottom line. You can see earnings growth and no sales growth. Well, that may be, it's maybe better than no earnings growth, but some of that earnings growth can just be driven by, say, cuts in the company, layoffs in the company, cutting down on spending. And therefore, ideally we want to see, and that's not sustainable for long periods of time typically. More efficiency, you can get more efficient for a little while, but at a certain point, you get diminishing results in your measures for efficiency. So that's why we like to see earnings growth and sales growth, top line and bottom line growth there, okay? So those are the first couple things that I would mention here as we're analyzing this. Another thing I would say is this. I'd like to see cash flow increase. And in particular, we're going to look at free cash flow here. And we're going to look for the same thing, free cash flow per share. This is just your cash flow subtracting out your operating cash flow, your capital expenditures. And the point is we want to see it going up. Okay? And cash flow, not really. I mean, we did over the past year. So all in all, this isn't spectacular here on any of these fronts on this, but we want to see growth in all those areas, cash flow, earnings, and that. Now, I mentioned efficiency. One way to measure efficiency is you can look at, there's different margins you can look at. Probably the most key one that most investors like to look at is operating margins here. And what we'd like is, it doesn't necessarily need to be going up, although that's a bonus, is we don't want it getting worse and worse. And in this case, we're not. We're holding our own, at least in terms of operating margins here. So that's another item here on this list. There's a lot of things we can look at. And so earnings, sales, cash flow, operating margins. I'm going to mention one more, return on equity. Here's return on equity. Again, we'd like it ideally to be going up, at least holding its own. And what I'm going to call this kind of holding its own the last few years there in terms of operating margins there. Now, those are all positive things. Those are all things that we want to be going up. However, there's other factors in there in terms of a strong company. One of which is we don't want it to be going up. We want it to be, if anything, be going down, at least holding steady, maybe, not too high. And that would be either long-term debt to capital. If you're looking at, say, the Schwab.com website, I think they have debt to equity instead of long-term debt to capital. Doesn't matter. Either way is going to be sufficient for measuring kind of risk in terms of over debt situations. Don't have that much debt here, actually. And if anything, it's been going down here. So that's okay. That's actually, give that a little smiley face there. That's good. Our debt to capital in this case here. So those are the main things I want to mention at this upper portion of this page. But then there's the issue of valuation. And there's different ways to measure valuation. The most common way to measure valuation is your PE ratio, okay? You can see where your current PE ratio is, 17, and then you can compare it to the past. That's certainly one way to do it. And this is just an average PE ratio. But here's another way to do this is I have a script, and I shared this script in the description on this webcast. And remember, scripts aren't guaranteed for accuracy or timing. But we have a PE ratio script here called historical PE where we can look at this. And I'll share that with you. And for those of you who are who are watching live, this is what the script is going to look like, first of all. And for some reason, this is not giving me a big history on this company. As we look at other companies, we'll see it gives you the full history here. But we can look at least over the past little while on this. Let me go back and just tweak this one sec. Let me just see if we got it. Go into the 3-year chart. I think maybe that's the key there. Okay. So in this case, we're comparing the PE to where it has been historically, against its own company. Against A.O. Smith here, we're comparing PE against its own company. Now, JV Texan mentioned in the chat, it can be varied by sectors and companies. You can compare this to its peers, and we did that actually 2 weeks ago, I think, or maybe 3 weeks ago. I taught this webcast, and we talked about peer comparisons on the Schwab website. You can do that. What we're going to be doing is we're going to be looking at different sectors that we're going to look at the same kind of within the same sector day, and we can compare one to the other. So when you compare a PE ratio, you're right, it's not an absolute number. You can compare it to its own history, which is what we're doing right now, or you can compare it to its peers, because comparing this company to an IT company, don't just look at the absolute number there on that. Good point. Thank you for bringing that up. Okay. So where's our PE compared to where it has been over, I got the last 3 years here on this. And you can see it's actually pretty low. It's lower than it's been. So that could mean the company's failing. It could mean their earnings are going way down. Well, we already saw the earnings aren't going way down. We'd say earnings are holding mostly steady, maybe going up a little bit, not much. But the PE ratio is actually going down a little bit. So that's probably a good sign from that standpoint. It's getting from that valuation standpoint, it's a little bit cheaper. Okay? So there you go. So that's how you can look at PE ratio. You can look at it compared to its 5-year average. We showed you that. And then you can also compare it just along the way to the high, which is representing this green number, and the blue, which represents the low value, which is where we're at right now on that. Okay. So that's evaluating the business. Those are all kind of key elements. And of course, you can look for some other things, but those are really the main ones that I would point you to. Now, we haven't talked that much about the dividend yet. And so what I want to talk about is the next step is evaluate the dividend. Okay. So that's the next one there. Oh, yes, thank you. I'm going to share that script there. So we're going to do, this is the PE script. Let me just go to Tools and let me copy that. And I'm going to put that right in here. Okay. And I think on this, we need to use the longer chart, the 3-year chart on this one there. Okay. We'll look at another example here, at least one other, and kind of verifying that. That's the script. For those of you who aren't watching in the recording, excuse me, aren't watching live for the script I just put in the chat, that's okay. You're not out of luck. I put the script in the description on the webcast. If you don't see it sitting there, you may have to click show more on that description to expand it out there. Okay. So let's talk about that dividend there. So obviously a standard way that we look at dividends is by yield, not just the absolute dividend number. And I have another script for you that I'm going to give you here. So let's look at the other script. And let me first of all add it. And it's a historical yield script, and I'll share that one with you as well. Historical yield. Let me just throw that on there. And I'm just going to kind of shrink this one down a little bit and expand this one a little bit. So here's where our dividend yield is compared to where it has been. Okay, dividend yield's gone up a little bit. Well, probably not a surprise that it's gone up some, given that the stock has gone down. Remember, the dividend yield is the amount of dividend in comparison to the stock price. Well, the stock price has gone down, yield is typically going to go up during that same time period. And so probably not a surprise we've had this little spike here on this, but that's okay. That's not a problem. We can see the dividend, the yield compared to where it has been historically. So there's that. So let me share that script with you. And again, this script is in the description if you're watching on a recording. Now, if you're watching live, I'm just going to share it with you here. Okay. And I'll put that in the chat and put that there. Now, for those of you who aren't familiar with this script thing, how do you add those in? Those aren't like URLs that you paste in your browser. What you do is you copy them, you go up to the gear, you click on Open Shared Items, you paste it right in here, and then you click on Preview. It, I think, gives you a chance to rename it, and then you click on Import, okay? So there you go. As I shared it, I named it just historical yield and historical PE, I think. But there you go. So we can see where the yield is. Now, in our script, in our initial scan, we looked at this and we brought this up. And this is right on the borderline, about 2.5%, which was the low that we put in that scan, 2.5%. So that's about where we are right now. So, but there's more to the yield, more to the dividend than just the yield, because we don't just want the dividend, we want the dividend to be sustainable. Okay, so something that we're going to look at is we're going to go to back here and we're going to look at that dividend yield. Excuse me, the payout ratio. Now, Paul said can't use script name. Oh, can't use I think what you're saying is you can't use a hyphen in the script name. There are conventions that you cannot use. There's characters you cannot use in the script name. So if you're renaming it, make sure you put in the appropriate symbols in there. You can't use hyphens in there. I can't remember exactly all the constraints on that. So just be aware on that. Thanks for the heads up on that. Okay. Now, the payout ratio. There's a payout ratio listed right here. It's listed dividend payout, percentage of earnings right there. That is just how much of the dividend is being paid out in comparison to the earnings of the company. Okay. So if the company makes, we'll say, $100 million in earnings, or we'll say, $3 a share in earnings, and it pays out $3 in annual dividends, that would equal, or $100 million total in annual dividends, that would be 100% payout ratio. That's probably not sustainable. You can't pay out every bit of money you're making in terms of earning, in terms of dividends. So therefore, people will usually look for lower dividends. Now, if you look at the sample investing plan for this webcast, what does it say? It says, look for an average payout ratio around 40%. That may be a little bit strict. A lot of people will go, well, I don't want it to be more than 60% or 70%, stuff like that. But clearly, and it can temporarily maybe go to 100%, but for over the long term, we don't want it probably near that 100% level. So just keep in mind, that's something we're going to check out in terms of the company's ability to sustain its dividend payout. Okay. Now, there's another thing I would mention that probably isn't as important right now as it would be if we weren't using a Dividend Aristocrat as a starting point. But you can go out longer term and you can look at the chart. Let me go back, I don't know, I'm going to go back 10 years. Click on OK. Here's 10 years. You can look on that chart, look at the little green dollar signs on it, and you can see the dividend year to year on that. And you got to be careful because I'm kind of putting my cursor on earning some dividends. And you can just look back each year and see the amount that the dividends increased. So even if you're not using this watch list that we were using where we know the dividends increasing yearly, if you're using a different watch list, it's something that a lot of people like to see is at least maybe not 25 years, maybe the last 5 years you want to see dividend increases. Okay. You can do that. And this is an easy way to do it. You can just look at that. Okay. So there we go on that. Now, so we have a sense for A.O. Smith here. We're sorry. Let's do the same thing. I'm going to go a little faster on the next one. And then what we're going to do is we're going to let me go back to scan, and let's look at another company in the industrial sector. So we're going to be comparing apples to apples, so to speak, here. And here's another company, Illinois Tool Works, paying about the same dividend. You got Automatic Data Processing, paying a slightly higher dividend there. And Stanley Black & Decker, a significantly higher dividend here. Now, there's pros and cons. Remember, there's more than just the dividend yield that we're going to look at. But let's look at Stanley Black & Decker, SWK here. So I'm going to pull up SWK. Now, something I should mention here. Some investors like to look at things like analyst reports. And just a heads up, analyst reports are third-party entities. They get it wrong. Sometimes their ratings are overly optimistic. Sometimes they're overly pessimistic. These aren't Schwab ratings. These aren't endorsed or guaranteed or anything. And I'm not going to go into them here, but Paul in the chat mentioned something that, you can look at certain ratings agencies, if you like, as just for an idea on an evaluation of a company there if you want on this. Okay. So let's do the same thing. We're evaluating the business. So we're back to step 2 here. We're back to step 2, evaluating the business, but we're going to look at a different company. Okay. So here's SWK, and we know this pays a higher dividend here than the A.O. Smith, which is what we're looking at. Notice more volatility right off the bat. So that for some traders, they like more consistency rather than these kind of wild swings. It has been increasing significantly the past few years, but it also it went down a lot more prior to that. So that's something, a consideration. Sales, you're also getting significantly more variation in sales, and sales have actually gone down a little bit the last few years. Not a ton, but substantial, 5% or so the last couple years in terms of the sales. Cash flow has declined a little bit the last few years. So we're seeing the difference between the companies that we're looking at here, both in the same sector. ROE is significantly less on this company. Okay? So when I'm looking at this, and let's look at our operating margin. Operating margins, significantly less on this company. So when you're looking at Stanley Black & Decker as compared to A.O. Smith, we have probably, just from these numbers, what a lot of investors would consider more risk warnings on this company, but a much higher dividend level on this company there. Which is better? I don't know. That's a question, you're going to have to evaluate for yourself. And just because there's more maybe red flags on this company than the prior one we looked at, doesn't mean that this one can't do better and the other one can't do, go to 0 or something like that. So there's no guarantees. I'm just saying how most people most kind of like common factors that investors will look at in terms of fundamentals, in terms of evaluating these. That's what we got there to start out. Okay. Now, I mentioned operating margin. We looked at that. We looked at earnings trends. We looked at sales. By the way, if you ever see numbers for revenue, it's basically the same as sales there in that regard. We looked at ROE, free cash flow, and that's, again, more volatility on that, declining a little bit here the last couple years. Kind of the same narrative we've seen on those other factors there for that. Now, let's scroll down a little bit here. Debt. You can see the debt's higher. Now, this isn't necessarily a massive debt level. What this means here is about 32% debt to capital. So for every $100 of capital, you have about $32 of debt on that. That's probably a fairly typical number there for these industrial stocks. But we can compare one to the other, and we saw A.O. Smith was a significantly lower number there on that. Okay. So long-term debt to capital, we looked at that. And now, are there other measures you could use? We don't have like ROIC, return on invested capital here. You could use that if you wanted to. There's substitutes you can use on these. I already mentioned on the Schwab site, instead of the long-term debt to capital, using an alternative there. Now, let's go to the dividend quality aspect of this one. Remember, we went to evaluate the dividend. So I want to look at the payout ratio on this company here. Let's go to that payout ratio. 124%. 172%. So that payout ratio, um, is very high. Okay, that payout ratio is very high on that. So Barbara says, why operating margin versus net margin? Actually, you know what? I'm going to retract what I said a little bit earlier. I said, look at operating margin. You can actually look at either of those. Those, I guess what I was actually meant to say is operating margin, probably more of a focus than the gross margin. Because like if you have, let's say you bring in revenue, okay? And I'm going to go through this fairly quickly. And you have, say, a cost of goods sold, okay? And then what you have is you have your gross margin there from after that. Revenue minus cost of goods sold is going to give you your gross margin. That's where you get your gross profit margin from. And then you have your operating expenses, okay? And then you have your operating margin from there. And so this would be a more key level than the gross margin. So, and then you have like, taxes and whatnot, and interest expenses that come in that are going to be subtracted out, and then you're going to end up with your net margin there. So you can absolutely use either of those, Barbara. Good question. Thank you for calling me out on that. I was a little sloppy earlier when I mentioned that operating margin versus net margin. I actually was trying to contrast that more with gross margin here on this. So both of those are going up, net margin and operating margin, but still not huge. 2.5% for almost any company is not a large net margin. There's no universal on that. Some companies have high margins. Some companies have lower margins. Walmart typically doesn't have a high margin. They just sell a ton of stuff at a lower margin, and that works for them. So, but but the key is we want to look at the trends here on this. Now, we mentioned payout ratios. That's kind of high, okay? So again, all of this is going to the same thing of there's probably a little bit more variability, maybe a little bit more risk perceived by a lot of investors, at least in Black & Decker versus A.O. Smith. Question from Barbara. Barbara, what's a negative payout ratio? What that means is typically they lost money during the year. Because remember, a payout ratio is the yield, how much you're paying out in comparison compared to earnings. Well, hey, you can't have negative yield. So if that equation is negative, it means their earnings was negative there on that. That's all that negative ratio is. So that's not a good thing. Even if the number's lower, if it's negative, that's not a good thing here. Okay. PE, let me go back to, I'm going to go back to my 3-year chart here. Our PE ratio is low on Black & Decker, and our historical yield is maybe a little bit more mid-range on that. Okay. So let me go back here. There's a fourth step, and that's what we've been doing. We're going to compare the best candidates. Okay. That's step number 4, comparing the best candidates. We just did a couple of those here. We came up with one that had a much higher dividend yield, but the rest of the numbers were, at least most of the rest of the numbers were, we'd have to say, were inferior there. Well, a lot of times you get that. Higher yields often kind of imply a higher risk on that. So the final step is compare the best candidates, and you can make your pick, or you can pick none. Doesn't mean you're not forced to invest. Make sure that you consider your whole portfolio. If you have a portfolio full of discretionary stocks or real estate stocks, you may consider diversifying your portfolio there as well. Okay. So everyone, I am out of time. That's a 4-step process that I encourage you to consider, at least as you're looking for investment opportunities in dividend stocks. I used today the Dividend Aristocrats as a starting point. That does not have to be your starting point. You can use any watch list of stocks that you want as your starting point. Evaluate your business, though. Make sure it's a strong company. Does you no good to invest in a poor company that's going to cut their dividend, or the stock price is going to go down a whole bunch there for you. And then evaluate the dividend along the way, and then compare one to the other within the same group there. Thank you, Ben, for helping me out in the chat. I always appreciate Ben. And thanks to each of you for taking some time out of your day and joining us. And we appreciate you. Coming up next, we've got Trading the Trend. Make sure that you subscribe to the Trader Talks channel. If you like the webcast, appreciate the thumbs up, the like at the bottom of the page there. Everybody have a wonderful rest of the day. We'll talk to you later. Bye-bye.